Hey everyone, how's it going? Welcome back to Lunch at the Market. We finally have some trades, right? We finally got a stock that dropped enough for us to get interested. That's right, Akamai looks terrible today, unless you've been waiting for this opportunity, which we have, and then it looks appealing today. And so what we've done is sold some June 34.30 and 33.30 put spreads that will expire in June. The stock is down about 15% today. It is getting absolutely walloped. The quarter actually looked good. It was the forward guidance and kind of the tone of management on the call. They said that future clients may have to be booked at lower revenue rates. So their ASP, their average selling price of their service, went down a little bit. That may be because they're seeing more competition in the market, or Limelight Networks is being more competitive, or there's some unknown competitor that's entering the market that we don't know about. But for now, mobile video is a secular growth trend, meaning if you think about the amount of mobile video that's being consumed right now, it will be nothing compared to what that amount will be in 10 years. And so we could actually see, we may even want to see additional players come into the space. That way everybody can be served. It would be really hard for just a couple of players to satisfy all the mobile video needs that all the different various companies are going to have. Heck, at Magnum Opus Financial, our YouTube videos, right? We generate a need for mobile video infrastructure because we do a video almost every day for Lunch in the Market. So that's the way to play it, is Akamai and Limelight Networks. I think both are down today. Limelight Networks LLNW is down in sympathy with Akamai. That's definitely a foreseeable pin action. What we should have done is had a put butterfly coming into today. That would have been amazing. So we'll probably yell at the interns a little bit to make sure that ahead of some of these earnings, especially tech companies, our favorite strategy is to go into earnings long a put butterfly. And all that is a long put spread and a short put spread with the middle strike, or the pivot point, the short strike being shared across. And so it's like 5, 10, and then 5. That's how a put butterfly works. It's just a long put spread and a short put spread with the short strike, right? A long put spread means you buy one put, sell another. A short put spread means you sell one put strike and buy another. Okay, that short strike is just simply shared by both spreads, and then that leads it to be called a butterfly for the combined structure. So we'll continue to like being long those butterflies. Even the trades, even the long put spreads that we did on Panera Bread and it starts with an A, but it's just totally slipping by, Amazon.com. Sorry about that, guys. Amazon.com and Panera Bread, we did both of those just as naked puts. The trade repair worked out okay, especially because Panera definitely went in our favor, meaning we were playing it for further decline. We got decline, and then it bounced from there. So we like those long put butterflies because it gives us great trade repair, and it really lowers the cost on that long put spread by selling. You're basically doing them in equal amounts. You buy 5 long put spreads, you sell 5 short put spreads, but then again it's 5, 10, 5 when you put the whole structure together. All right, the other trade, silver. Silver is a rocket ship, and it's a very interesting trade. It's really hard to tell at this point where exactly all the demand is coming, and it is seen as the poor man's gold. And as gold continues to rise, there will continue to be people who don't want to lay out that kind of capital, and so will play the precious metal trade through the silver market. So, in a way, you could say as long as gold goes up, silver continues to go up. So it's an interesting trade. So for free, what we did was we bought 2 43.45 in the money call spreads, and then sold 6, right? So it's a 3-to-1 ratio, 6 40.35 put spreads for the month of June. So again, we're long the 43.45 call spread, and then sold the June 40.35 put spread against it 3-to-1. That allowed us to put the whole trade on completely for free. In fact, we took in about $26 per structure, about 26 cents for the whole structure, times 2 different structures in several different accounts. We get a $2 max upside in that long call vertical, and to pay for that $2, right? Which is, it's already in the money, right? The 43.45 in the money SLV call spread is already completely in the money with this, the ETF trading around 47. So what we've done is we've allowed, right, we could see some decline, say 5%, still be okay, still reach full max profit on our long call spread. The short put spreads are just to finance the trade, okay? We don't experience losses until the SLV gets to around $39.74. It's about a 20% decline from the recent highs of about $48. So that's there's a lot of protection there. It's a very low risk trade. It has a great return, obviously taking in 26 cents, getting paid an additional $2 if the ETF finishes above 45 by June expiration. It's a really great risk reward in the trade. I like the trade a lot. It's a nice free way to play silver, and you don't have to swing for the fences. So those are our two trades today. Akamai, June 34.30 or 33.30 short put spreads, and then of course the silver we're going to get long, the in the money 43.45 call spread, and then pay for it by selling 3 40.35 put spreads against it, all of which expires in June. The object is to get SLV above 40 and for Akamai to be above $34, both for the June expiration. Thanks for joining us again today on Launch of the Market. We continue to look for short put spreads that we can buy back at better than 84% profit. When we do, we're in raised cash mode. We'd rather be safe than sorry. The Akamai trade is a good example of a trade where when the stock was trading at $41, we were just under that level at about 75% profitability on the previous spreads that we had sold that expire in May. We could have taken those off and then, relayed them out. Obviously, hindsight is 20/20. So once bitten, twice shy. As we see things go against us, we continue to get more and more conservative in terms of when we take off those put spreads versus riding them for full profit into expiration. Thanks for joining us again today. Have a great day, and we will see you tomorrow on Lunch of the Market.